Hey guys, and welcome to Zonos Crypto. In this video we will take a look at the latest news right now. Okay, let's hit it. As you can see, the global crypto market cap is 1.07 trillion. It has increased about 4% over the last 24 hours. What are the largest gainers? Largest gainers in the 24 hours are NEM, Lido, and also Bitcoin. Over the last 7 days, Lido by 130%, Ethereum Classic 81%, Polygon 71%, and Ethereum 57% actually. Bitcoin coming in at 23,847, Ethereum over 1600, BNB at 270, Cardano 52 cents, and XRP at 37 cents. Okay, let's get into the first story of today. Polygon, zero-knowledge EVM rollups aims cheaper Web3 transactions. Polygon uses zero-knowledge proof to club multiple transactions into groups before relaying them over to Ethereum blockchain as a single transaction. Polygon, a Web3 infrastructure on the Ethereum blockchain, announced the launch of Polygon ZK EVM, or Zero-Knowledge Ethereum Virtual Machine, a Layer 2 scaling solution aimed at reducing transaction costs and improving scalability. The new zero-knowledge ZK scaling solution, Polygon ZK EVM, operates in full compatibility with existing Ethereum-based smart contracts, developer tools, and wallets using zero-knowledge cryptography protocol, aka ZK proof. This ability to transmit multiple transactions as a single transaction results in lesser gas fees, thus bringing down the gas fees when compared to sending them separately over the Ethereum blockchain. There's a spelling mistake. Ethereum's average gas fees fell down to $1.57, a number last seen in December 2020. As a result, Polygon ZK EVM is well positioned to bring down the infamous gas prices further. Polygon estimates a 90% reduction in costs by using the ZK rollup approach. Now, will Ethereum merge hopium continue, or is it a bull trap? ETH has gained 48% over the past week, leaving the most of its crypto brethren behind. Though it's still risky days ahead given the macroeconomic factors at play. Ethereum is outperforming the broader cryptocurrency market as the highly anticipated merge approaches, but the bigger picture is still largely bearish. ETH has gained a whopping 48% over the past 7 days, outperforming its big brother Bitcoin, which has only managed to achieve 90% in the same period. It's also up 66% from its market cycle bottom of $1,918 on June 19th, reaching its current price of $1,549. However, the current ETH rally could be a bull trap, with the macroeconomic clouds darkening. A bull trap is a signal indicating that a declining trend in a crypto asset has reversed and is heading upward when it will actually continue downwards. The primary driver of recent momentum for the asset has been linked to the announcements regarding its switch to proof of stake, which has been slated for September 19th. The merge will reduce the network's energy consumption by more than 99%. When scaling takes place via sharding, which is expected sometime next year. What do you think about the merge from Ethereum from proof of work to proof of stake? Are you excited for it? What is your opinion regarding the switch from proof of work to proof of stake? Now, how DeFi on Ethereum is evolving through crypto winter. Crypto Briefing explores how Ethereum DeFi protocols are expanding their product offerings and experimenting with governance during the current market downturn. What are some key takeaways? DeFi has suffered in the crypto slump, but many stable projects are still building. The likes of Aave, MakerDAO, Uniswap, and Lido have all put forward experimental governance proposals or made major announcements in recent months. If DeFi is to reclaim its highs, those building through the bear should emerge stronger than ever. Some of Ethereum's most prominent DeFi protocols are taking advantage of the current market downturn to rethink the governance structures, or offer completely new services. What are the plans for the future? Notable among the projects showing signs of evolution are mainstays of Ethereum DeFi, such as the lending protocols MakerDAO and Aave, the popular decentralized exchange Uniswap, and the leading Ethereum liquid staking platform Lido. These protocols, along with Curve and Compound, are considered fundamental to the ecosystem's financial stack due their technical innovations, high security, and the amount of capital entrusted to their smart contracts. All of the blue chips appear to be weathering the current storm and have continued developing their protocols and even expanded their offerings. Okay, what are the biggest updates of the last few months? MakerDAO integrates traditional finance, Uniswap expands to NFTs, Aave discusses launching its own stablecoin, and Lido experiments with governance. Lido Finance unveils plans to expand to Ethereum Layer 2 space. Lido Finance, a decentralized finance startup that provides liquidity as a service (LAAS), as well as working as a third-party staking pool operator for Ethereum 2.0, has announced plans to expand its platform to Ethereum's Layer 2 space. Layer 2 solutions, what are these? They are designed to scale the Ethereum network by moving some of the processing off-chain. Lido plans for expansion will reportedly begin by supporting staking for Ether (ETH) through bridges to Layer 2 solutions. If you've enjoyed the video so far, please leave a like, subscribe, and also hit the notification bell so that you will not miss anything in the future. Celsius was absolutely trading sell to manipulate the price, said the former executive. Timothy Cradle, the former director of financial crimes compliance at Celsius, has alleged that the company engaged in potentially illegal market manipulation using customer funds to artificially inflate the CEL token's price. What are the key takeaways? Timothy Cradle, former director of financial crimes compliance at Celsius, has accused the lender of deliberately manipulating the price of the CEL token. Jason Stone, the head of a firm that managed over $2 billion for Celsius, separately accused the lender of price manipulation in a lawsuit filed for July 7th. According to its bankruptcy filing, Celsius has a $1.19 billion hole in its balance sheet and owes $4.72 billion to its customers, but its terms of use mean they may never get their funds back. Celsius is quite in a dilemma. Celsius faces market manipulation allegations. Celsius deliberately manipulated the price of its CEL token, one of the firm's former executives has claimed. In a Tuesday CNBC interview, the former financial crimes compliance director at Celsius, Timothy Cradle, said he had overheard other company executives discussing pumping up the CEL token at a company Christmas party in 2019. They were absolutely trading the token to manipulate the price, he said. Okay, now to some news regarding Gemini. Crypto exchange Gemini axes 7% of its staff in second wave layoffs. Gemini, the cryptocurrency exchange owned by the Winklevoss twins, is laying off more staff. According to reports, the company is axing 7% of its current workforce as it engages in significant cost-cutting policies. This is the second wave of layoffs at Gemini, after the company laid off 10% of its staff less than 2 months ago. About 7% of its current workforce are about 68 employees which are leaving the company. Okay, then to Skybridge. Skybridge pauses withdrawals amid steep decline in stocks and crypto. Skybridge Capital joined a growing and unenviable list of funds that have paused withdrawals from one of its crypto-exposed funds. However, Skybridge founder Anthony Scaramucci stepped in to assure customers that a suspension was only temporary and that no assets were at risk for liquidations. Skybridge Capital has announced that it's temporarily halting withdrawals from its Legion Strategies fund due to its crypto exposure. The move was confirmed by Skybridge founder Anthony Scaramucci In an interview on 19th of July 2022, after several reports emerged about the pause through anonymous sources. Our board made the decision to temporarily suspend until we can raise capital inside the fund. The fund is unlevered, so there's definitely no fear of any liquidation whatsoever. And about 80% of the fund is in what we would call crypto exposure. An independent board also took part in the decision. What do you think about the pause of withdrawals on Skybridge? Okay, now to the last point. SEC unethically going after crypto companies outside of its jurisdiction. The Securities and Exchange Commission (SEC), along with its chairman Gary Gensler, were lambasted during the House Committee on Financial Services on Tuesday by Republican Senator Tom Emmer. He accused them of unethical action against crypto companies. Here is the video. We will take a look right into it.
Take, for example, industry sweeps. As you know, industry sweeps are not novel to the digital asset industry. They are a series of voluntary document production request letters as a regulator sends to everyone in a given industry who is similarly situated or is involved in the same type of activity. Mr. Grual, does the SEC Division of Enforcement do industry sweeps?
We do industry sweeps from time to time when we have indicia.
Thank you. The answer is yes. I reclaim my time. Are there currently any industry sweeps underway?
So I can't talk about investigations.
You can't talk about it legally, or you won't talk about it?
It's our policy not to confirm or deny investigations.
So you won't talk about it. All right. What do you do if a company, sir, cannot respond to a sweep letter because they're not in your jurisdiction?
If we issue a voluntary request for information, there's not much we can do. We can proceed with the subpoena and then a subpoena enforcement action.
So you do extra jurisdictional requests then?
Voluntary requests are just that. They're voluntary. They're an important part.
Again, sir, I'm not asking about the request now. I'm asking about the people you direct those to. There are some that would be within the SEC's jurisdiction. There are some that are not. My question is, and I think you've confirmed it, that you do industry sweeps to extra jurisdictional market participants, people you do not have enforcement authority over.
We subpoena individuals and witnesses who may be in the market participants.
Are they within your jurisdiction and outside of your jurisdiction?
We're not limited by our jurisdiction. When we're collecting evidence, we follow the evidence wherever it leads and to whomever it leads. There may be someone who doesn't work in the industry who might have information.
I would say, sir,
go after them.
I would ask you, so you do extra jurisdictional work. Some would argue that that's not appropriate. But Mr. Grual, has Chair Gensler ever directed you, or to your knowledge, asked any of your colleagues to make it a bloodbath for companies who don't respond to a sweep letter, which are voluntary?
No, that's not happened.
Interesting. We become aware that Chair Gensler has in the past directed the Division of Enforcement to send a sweep letter to a particular sector of the crypto community designed to jam them into a violation that is allegedly unconstitutional. And if any company does not respond to said sweep letter, which I'll reiterate, as you've said several times, are supposed to be voluntary, then the SEC would make it a, quote, bloodbath for them. If true, I imagine such a tactic would significantly erode trust between the public and the SEC.
So what do you guys think about the SEC sending sweeping letters to companies out of their jurisdiction, and then if they not answer, they make this a bloodbath for them? What is your opinion on it? Okay guys, thank you very much for watching. I hope you have a great day, and we will see us tomorrow or the next day. Peace out.